All right, I'd like to start documenting what I'm doing, this experiment where I've created a Roth IRA on Robinhood. They have a promotional deal where they will match 3% of your deposit. So what I've done is deposited $1,000 into a Roth IRA account on Robinhood. The reason I'm doing $1,000 is that's what I have available, and I want to do a small account because I'm a new trader, and most new traders destroy their first account, making mistakes. So I don't want to put just start trading brand new with a very large account or something, even if I had the money to do that. Why a Roth account? There's tax benefits. There's no tax penalty for active short-term trading. So that simplifies things. And also they're giving a 3% bonus, which would be $30 that I have available immediately to trade with. And so my goal is to execute a series of trades using risk management such that my maximum risk does not exceed $30. So what do I mean by risk? Let me explain that with an example. Let's say that I find a stock that I want to buy and it's priced at $100 per share. And I go ahead and buy it. And I say, look, if the price goes down to $95, then I don't like this anymore and I want out. So I can enter a stop loss order at $95. So if price dips down to $95, then I get out. And that means that I'm risking $5 per share. So if things go wrong, I lose $5 per share. Now let's say that I buy 3 shares. So that would be an entry cost of $300 and a risk at $5 per share. That would be a total risk of $15. Then my plan for reducing risk later in the trade, let's say it goes my way, and let's say price goes up to 110. That would be going up by 2 times my initial risk of $5 per share. So once it reaches 2R, 2 times risk, then I'm going to sell 1 share. And so I will take in a profit of $10, which since I started with $15 of risk in the trade, that would leave me with $5 of risk in the trade. And I would like to even reduce that further by now moving my stop from, instead of stopping out at $95, since we've already gone up to 110, if it goes back to where I started again, then I'm out. And so that eliminates my final $5 of risk. And so I'm trading 2/3 of my original position with no risk in the trade. So that's kind of this is how I manage risk and how I define risk. And so let's go ahead and look at the first trade that I made. I'm going to switch over to my trading view. This is a ETF called GDX, the VanEck Gold Miners ETF. And it has been on a trend starting, if we kind of zoom out, we're looking at a daily chart here. So back here in August, at the beginning of August, it broke above the 21-day moving average and has just ridden up on this beautiful trend. And these lines that you see here, I have the 5 EMA, the 5 exponential moving average. This light blue line is the 21 EMA. And down here, this dark blue line is the 89 EMA. So, and I actually had a position in another account. That's what these marks are down here. And so I was watching this every day, and it just in such a strong trend. And then this bar happens. Where it looks like it's retreating back to the 21, and it finds a bounce down here intraday. This is on October 9th. And if we looked at an intraday chart, I like to use the 78-minute chart. That splits the day into 5 equal pieces. This is what I was looking at on. And let's zoom out here on the 78-minute chart just to show you this trend. It had been trending above the 21 EMA on the 78-minute pretty well also. That's roughly about what the 5-day EMA is. But anyway, I was looking at this, and it looked like it was going to bounce on the 89, and I decided to play this bounce. And I entered here, and so what I like about playing this bounce is it gives me a well-defined risk. If things don't go my way and it ends up breaking below this 89 EMA, not finding support there, then I'll know pretty quickly and I can just get out. And so my entry was right here on, this is on October 9th. And I entered at a price of $74.80. And what I like to do is, let's go back to the daily chart here. What I like to do is set my stop loss, give it about 1 ATR below my entry price. The ATR is the average true range. That calculates the average range the stock moves on a daily basis, and I do that over the last 21 days. And that's that. The ATR down here in the bottom left corner was at 1.96. So let's zoom in here to my entry. So this green horizontal ray, that's my entry at 74.80, and I set my stop loss at 72.84. So I have $1.96 of risk per share. And remember, I'm starting with an account of $1,030, and so I decided to buy 13 shares. And as I mentioned, I wanted to split those into thirds, which 13, I could have done 12 to make the splitting into shares more even, but I just want to get approximately there. I don't have to be exact. So I bought 13 shares at $74.80, and my plan was, if the price goes up by 2 times my risk, which would be right here on the second purple line, that would be 78.72. So if price goes up to 78.72, then I'm going to sell 4 shares. That's roughly a third of my 13 shares. Okay, so that's my plan for my my first exit on strength is if it goes my way up to 2 times risk, sell 1/3 and try to get into that free roll situation that I was describing in general earlier. So let's look and see what happens. If we play 1 day forward, it just kind of stays about even the next day. Then the next day, it jumps up to my 2 times risk point there that I had at 78.72. Now, I had defined in my rules that I was going to sell here, but I didn't define how I was going to sell. I think the proper thing is if you look I try to check on the market near the close of the day each day. I think I should have just sold immediately to lock in my profit. But what I did instead is I set a stop order just a little bit below this 2 times risk point. And I said, well, I'll see if it wants to just keep going up, I'll let it keep going up. But if it starts backing down, then I'll go ahead and sell near my 2 times risk point. And so the next day, in the morning, it went down to where my stop loss was and sold. And then it went back up a little bit closer to where my 2R is. And so I sold 4 shares at 77.75. And so now I have 9 shares to let ride. And I also, I didn't move my stop all the way up to break even. I wanted to give it a little bit of wiggle room. So I moved my stop up just a little bit. Then the next day, we get a beautiful candle. Price jumps up. And I don't have a sell on strength rule at this time. My plan now with the remaining 9 shares is as long as this BX stays bright green, then I'm good. I'm going to let it run. But if the BX turns to dark green, then I'm going to sell another 1/3 of my shares. And the next day it goes up, and so we can see here we're at 1, 2, 3, 4. We go all the way up to 5R, 5 times my initial risk. And it looks quite extended here. In hindsight, it would have been nice if I had a sell into strength rule where we've gotten extended above this 5 EMA. That might be a good place to lock in more profits. But I didn't have that rule. I'm waiting for the BX to show weakness before I sell my next 1/3. And then the next day, it does that. It shows weakness. It goes down at the end of the day. The BX is turning dark green, and we're right back to where my 2R point is, and I sell another 4 shares. And my price here was 79.06. Then the next day, it recovers a little. The BX turns back to bright green. I'm holding 5 shares. And my plan is to hold them. What I did is I want to hold it as long as this rides above the 21 EMA. And I was even willing to give it a little bit of wiggle room because I am using stop loss orders. And what I did, I said, look, if it closes below the 21, then I'm gonna exit but I'll give it some wiggle room down to the 34 EMA, which is where I set my stop. And then the next day, we get a disaster candle. It just totally collapses. Gaps way down. This is, let's get our measuring tool out. So we closed on October 20th around here. And so it's gapped down about 9.5%, which is pretty drastic for an ETF. And so it stopped me out here. My final sell price for my remaining 5 shares was $73.78. So that's how that trade went. I think looking back on critiquing this trade, what I really don't like about it is that I entered when the BX trender was so high, like so near 40. It's hard for the BX to stay that high, and so I think I could have anticipated that we were in for some volatility in this trade. And also, I think I should consider adding a sell into strength rule when we get a really great candle and we're up to a very good multiple of our original risk. So I think having a rule of selling into strength there would be good. Let's look at how I did on the trade. So here's the details. I bought on October 9th 13 shares at $74.80. So my purchase price was $972.40. And then on the 14th, I sold 4 shares and made a profit of $11.80. Then on October 20th, I sold 4 shares and made a profit of $17.04. And I got stopped out of the final 5 shares for a loss of $5.10. And if you look at this is how my account balance. Remember, we started at 1,030. And so the account ended up at $1,053.74 at the end of the trade. Here's some summary facts about the trade. So the amount that I put into the trade was $972. The amount that I took out was $996 for a total profit of $23.74, which is a return on investment of 2.44%. My risk in the trade was $25.48. Therefore, my profit to risk ratio, profit divided by risk, was 0.93. So it didn't quite make 1R. 0.93 R is what I made on the trade. And remember, it kind of hurts because I could have taken more profits when we were up to that 5R at one point during the trade. But still not a terrible result for considering that nasty gap down that happened during the trade. To get out with a profit at all, I think is good. So my account started at 1,030, went to 1,053 for an account impact of 2.3%. And that happened over 8 trading days. And there's a number we can calculate based on, I'm basing it not on what my trade ROI was, but what my account impact was. So if I could increase my account by 2.3% every 8 days for a whole year, then I would be able to double my account in 1 year. So this is the annualized return. Now that's not a realistic thing probably, but this gives us a measurement. So when we do other trades, we can that maybe last different amounts of days. This gives us a way to compare trades based on an annualized return. Okay, so that's my summary of the first trade in this Roth IRA. I have started my next trade, and I will post another video when that trade is over and summarize that one.